Over the past 48 hours, the global cross-asset markets violently repriced in a massive, coordinated, algorithmic liquidation event. The immediate catalyst was an 11th-hour geopolitical pivot. The United States and Iran have agreed to a conditional 2-week military ceasefire. This temporary pause was brokered through back-channel mediation by Pakistan. The stated goal is to safely reopen the Strait of Hormuz, avoiding a regional escalation. This chart captures the immediate market divergence. On one axis, West Texas Intermediate crude oil plummeted 16%, dropping back into the $94 range the moment the threat of an immediate physical supply shock vanished. Yet on the other axis, spot gold ignored standard risk on logic. Instead of selling off on the relief news, bullion surged 2.5%, eclipsing $4,800 per ounce. The sudden evaporation of the roughly $30 geopolitical Hormuz premium forced a massive algorithmic short covering event across equities and commodities. Equity markets are celebrating the de-escalation, but capital allocators are watching the fine print of the upcoming negotiations. The relief rally assumes a return to normal, but the 10-point proposal on the table suggests the underlying economics are shifting. Market consensus assumes the end of active hostilities will send crude oil back to its pre-war baseline of $64 to $65 per barrel. That math is becoming difficult to justify. Global strategic petroleum reserves are severely depleted following the historic 400 million barrel emergency release coordinated by the IEA. Simultaneously, U.S. shale producers remain bound by strict capital discipline. They are prioritizing shareholder dividends over new drilling, which prevents them from rapidly flooding the market with new physical supply. The mandate to rebuild these strategic stockpiles creates a massive, sustained buyer in the market, establishing an elevated fundamental floor for crude oil in the $85 to $90 per barrel range. That elevated baseline assumes maritime shipping resumes smoothly. But the framework for the upcoming negotiations in Islamabad relies on Tehran's new 10-point peace proposal. The most economically disruptive mandate inside this proposal is a demand to institutionalize a transit fee of $2 million for every vessel passing through the Strait of Hormuz. Tehran proposes sharing this revenue with Oman. The funds are earmarked for domestic reconstruction, acting as a mechanism to extract indirect war reparations from global logistics networks. The logistical paralysis is already visible. Major Japanese and European carriers, including Nippon Yusen and Maersk, have suspended transit operations in the region. If a fraction of this Hormuz tax is formalized, the era of frictionless, low-cost shipping ends. It points to sustained margin compression across the global maritime logistics industry. If the geopolitical risk premium is evaporating, gold should be selling off. Instead, institutional capital is aggressively accumulating bullion. This chart maps the relationship between oil prices and the dollar. As crude oil collapsed, it reduced the expectation of a secondary warflation shock, causing the US dollar index to drop nearly 1%. Because gold is priced in dollars, this depreciation subsidized bullion. Institutions used the discount to hedge against fiat debasement, decoupling gold from traditional risk models. The test of these inflation expectations arrives on April 10th with the release of the U.S. March Consumer Price Index. Looking at this breakdown of consensus forecasts, headline inflation is anticipated to jump 0.8% month over month. This acceleration is driven almost entirely by the recent spike in gasoline prices caused by the blockade. The Federal Reserve operates under the reality that rate hikes cannot manufacture commodities or unclog maritime bottlenecks. As Jerome Powell has stated, the central bank knows it cannot print oil, and the FOMC will likely look through this specific supply-side shock. However, CFOs and fixed income markets must look past the energy component. The underlying inflationary threat lies in the 3 Fs currently working their way through the global system: fuel, fertilizer, and finance. The recent closure of the strait halted massive volumes of Middle Eastern fertilizer exports. Because these inputs take months to work through the harvest cycle, agricultural and food inflation is positioned to remain sticky well into Q4, keeping fixed income yields sensitive. The United States is navigating this shock from a position of relative energy independence. The same cannot be said for net energy importing nations, specifically Japan. Japan historically sources approximately 90% of its total crude oil directly from the Middle East. The plunging yen pushed the U.S. Dollar to yen pair passed the 160 intervention threshold, but the drop in oil prices provided temporary relief, pulling the pair back near 158.85, saving Japan's Ministry of Finance from direct market intervention. The Bank of Japan remains in a policy trilemma. They must support a weakening currency, but hiking interest rates to defend the yen risks deepening a domestic economic contraction. You can see the microeconomic fallout of this dynamic within Japan's energy-intensive utility sector. Consider Kansai Electric Power Company. This fundamental data card shows Kansai Electric operating with a 1.12 debt-to-equity ratio and a return on capital employed of just 4.58. These metrics render the utility exceptionally sensitive to input cost shocks. To compound the threat, the Japanese government terminated its electricity and gas price subsidy program on April 1st, exactly as spot prices for liquefied natural gas are threatening to double generation costs. Japan is caught in a convergence of imported stagflation and fiscal dominance. This points toward margin compression across their industrial base, exposing the limits of the ceasefire's relief. We are operating inside a 14-day diplomatic window. Achieving a long-term peace agreement that incorporates Iran's maximalist demands, including the removal of sanctions and the Hormuz toll, faces high diplomatic hurdles. Capital allocators should consider a bifurcated strategy. First, use this algorithmic mean reversion in crude oil to secure tactical hedges. Executing long hedges at the current $94 WTI dip offers an asymmetric risk-reward. If talks stall, the $30 Hormuz premium will violently re-enter the market. Second, corporate treasurers should move to neutralize Japanese yen currency exposure using options or forward contracts. If the ceasefire expires on April 24th without a breakthrough, an unchecked currency collapse in the yen remains a high-probability tail risk. Regarding sector rotations, institutional portfolios should move to an underweight position in global shipping companies. This caution extends to auto exporters reliant on Middle Eastern transit. Regardless of the diplomatic outcome, their operational risk profiles and baseline shipping costs have shifted. Instead, pivot capital into domestic North America oil and gas equities, insulated from direct shipping risks. Also target agricultural chemicals and alternative energy infrastructure. Both are defensive plays, benefiting from the push for localized supply chain sovereignty. Capturing the relief rally is a tactical move, but long-term allocation requires a different posture. Corporate survival now depends on embedding protection against a global supply chain that is increasingly expensive and militarized.